Okay, ladies and gentlemen, thank you very much for your patience, and thank you for those who have also joined us recently. Just for your reference, this entire conference is being recorded and it will be shared with all of you shortly via an email link as well. Just to note that in the chat, we have several links and profile links as well for some of our speakers and some of the content that has also been shared as well. Okay, let's move on to our panelists. If I could kindly ask for all of our speakers today to join us with your cameras and to also unmute yourselves as well. Wonderful. Thank you very much for joining us and for returning as well. We actually have a couple of additional speakers who will be joining this specific panel today. I think also to provide some support for some of the more technical questions. But so I will introduce you in a short moment. But again, I would ask that if any of our audience have additional questions, please send them now, or if you would like to follow up on some of the comments made by our speakers, then please feel free to do so. And I would ask you to direct them directly into the Q&A box below. So joining us, in addition to our speakers from earlier, we have Alexander Yavorsky, who is a project manager at Deep Knowledge Group. Alexander, hello.
Hi, everyone.
Hello. He is also a mathematician with a pharma background who is focusing on leveraging big data and machine learning in order to create predictive analytics and database market insights for longevity financial advisors, which Talbot is also involved with, and also the world's first longevity-focused capital advisory firm. Combining different ML-based approaches, he leads the next generation customized IT platform for venture capital and private equity. Alexander is interested in mathematical and AI applications in investment, finance, banking, and other areas. And it notes that you also speak 6 languages fluently, including Chinese, Ukrainian, and German, which is really impressive. But I would expect no less from somebody with your accomplishments, for sure. We also have with us Nikita. Yes, I see you are online. Hi, Nikita.
Hello.
So we have Nikita Bursenev. He is a quant analyst at Deep Knowledge Group, a quantitative analyst, former researcher in the field of matrix theory and control theory, which is ICS-RAS. He is interested in financial models, including stock performance prediction based on financial and non-financial parameters. At Deep Knowledge Group, he provides quantitative analysis and performs market research, as well as developing pricing models. He has several years of experience in managing long equity portfolios, and he holds a master's in physics from MIPT, which is based in Moscow, and currently is finishing his master's of finance course at the University of Bologna. And I believe you are also a CFA candidate, and you've passed a few of your exams with one pending.
Yes, that's
congratulations.
Right. Thank you.
Wonderful. Welcome back to our panelists from earlier. We have Alpesh, Talgat, and Anastasia Korshik, and of course, Dmitry Kaminsky. So let's begin our panel discussion. I would like to start with a question that I'm going to put out there, which I think is a very broad question, and forgive me for my naivety in asking this, but we have several members of our audience who are joining today who may have just been introduced to the concept of investment technology and innovations in investment. So I would like to ask, and again, forgive me for such a basic question, are investment technologies worth investing time and money for? And if so, why? And I would be very interested to hear some short arguments from various speakers today as to what you would say, and I suppose your elevator pitch to those who have joined this sort of frontier of technologies and are intrigued. So who would like to take a?
I would probably start a little bit and then give a word to Anastasia. So of course, everybody of you are quite aware about CRM, Client Relational Management System, and there are many of them, and most of them are quite typical. And 2 years ago, actually, probably the first effort was 3 years ago. We were considering, to buy such CRM, professional CRM system, and then somehow to, a little bit adjusted towards, let's say, business development, or in the best case scenario, towards investment relations. And what we have found that there are actually probably 2 or 3 possible solutions, each of them either very expensive and not very much efficient, or either they're cheaper, but will require quite a lot of software programming to, design them. And eventually, we understood that even the best possible, like really sophisticated solutions, they're not that best, in the sense that for our purposes, not Salesforce will not work in full capacity, not even something similar. In fact, they are a little bit cheaper, just less promoted systems compared with Salesforce. So we're meaning this. In our case, for our investment decision making, to design our investment strategies, we had to design our own proprietary big data analytical system for actual investment decision making. In our case, like for our deals. But now we are kind of going even further. So we're kind of working to implement our own, not CRM, but IRM system, investment relations management system, specific software with some machine learning techniques, which will be specifically designed to automate in some capacity some routine process which any company will be facing whenever they will want to make some kind of any technical fundraising process. Doesn't matter on the side of startups which are looking for investors, or vice versa on the side of investors, because each of the investor for deal flow, some assistance to technical stuff in venture fund, investment fund, they will have to do quite a lot of routine boring work, which could be very well optimized in nowadays using some specific good software solutions. So on the stage, probably without too much specific details, because this is a little bit of proprietary solution, but just to iterate a little bit on the idea that whenever any 2 parties kind of, I would say, in this sense, which want to get married, but in this case to be matched, in this case between investment targets and investors. So there is a lot of technical routine process which should be improved, optimized, and just enhanced with software. The very same as a lot of things already were improved and resolved with software development over the last 10-20 years, since the proper implementation of internet happened everywhere.
Sure, Dmitry. So thank you for the speech. And also, I would like to continue that nowadays the AI and different software solutions that allow us to find the perfect match, as well as our big data analytics dashboards, they also allow us to match the investor with the startup that he's looking for, as well as to find the contacts and to get all the information like dynamic SWOT analysis and comparing tools to compare the startup with another companies to see who is his competitors and etc. As well as nowadays you can, as I showed in my presentations, that you can use different InvestTech solutions to build your own portfolio, to compare different companies, to manage your assets, and even issue active demand certificate using such data tool. Moreover, these days they are quite challenging for all the investors, considering the environment, the recession, and especially in these days, many investors, they are seeking for the targets where to invest in, because they need to find this way to avoid the recession of their real assets. And in this case, the usage of the new structured products like AMCs and special purpose vehicle companies could be an answer, as well as finding a good company. And in this case, we are also launching the Longevity and DeepTech SPV platform, where all the investors can find the perfect match, like Dmitry said, the marriage with the perfect company, as well as the company could issue its own SPV and as well as use the IRM system. So there are many approaches on how to solve all these challenges these days. Thank you.
Would anybody else like to jump on that? Or to add anything in terms of the huge advantages that they feel can be brought?
Yeah, I'll just add a couple of cents. AI ML is getting increasingly irreplaceable in the field of investing. There are some estimates which say now that the vast majority are in fact adopting these methods. It gives the manager an extraordinary amount of scale and scope in terms of coverage of various markets and sectors, which they can now do without having to invest in a staff of fundamental analysts who go through research reports. It's all available in data form. And so here you have the machines do it and do it in real time, which would not be the case otherwise. And so speed of computation basically far exceeds anything done away from AI and ML. Accuracy, working with a sharp pencil instead of a broad brush, that's huge. Making numbers-based predictions instead of qualitative assessments on buy and sell and how much to buy and sell. These are all separate facets that AI and ML bring, and in general, quantitative investment brings.
Absolutely. And it's interesting that you mentioned some of the predictions, because we are speaking relatively in terms of AI being a really useful tool to assist. But where are we in terms of trusting AI with, and trusting not just AI, but technology in general with investment decisions, especially where we have risk involved?
Yeah, so again, I'll just add my thoughts, and they are not by any stretch of the imagination the answer, but no singular AI model provides the gospel truth. And so by and large, everyone uses an ensemble approach where they use different AI machine or models to make their individual predictions, and they use then some approach to sensibly combine the outputs to determine the strength of the decision. So again, if you ask any person implementing the model or the strategy, they'll all have different answers, and there's no one perfect answer, is all I could say.
Of course. Would anyone want to add to that in terms of?
Yeah, I would like to add a couple of points to my colleagues already in terms of IRM platform that has been developed by Deep Knowledge Group. Speaking from the personal experience and the experience with dealing with startups and investors, capital raising procedures can be draining, because especially when you do everything in terms of not quantitatively but qualitatively, and especially draining not only for the personnel who is actually responsible for searching investors or searching startups. It can be draining and for founders as well, for managing partners, because it takes lots of time and it takes away your focus on your main business. And when you actually involve AI into the process, it's not only about trust, but it actually saves you lots of time. This has been pointed by my colleagues. And time is money, and it actually helps to accelerate the whole business process and the process of matching, of engaging for both the investors and the capital raisers. And speaking more in terms of trust, yes, I think we definitely and absolutely can trust AI, because sometimes, like most of the times, people make mistakes as well. So if you, like, for example, looking for a company to invest, there is no absolute guarantees that you won't do a mistake. But what AI does is it does number crunching, and numbers don't lie. Especially, this is why I use my presentation. For example, I wanted to make an input of as much statistics as possible, because when you look at the numbers, they tell the real story. And what AI actually helps is to gather and take away all the noise and put numbers on the table. Absolutely. So this is why I think we can absolutely trust AI, especially in the platforms.
I think trust is a very, very key concept here, because a lot of what you've mentioned in terms of visibility, blockchain is a fantastic example of how you can actually have that visibility to reestablish your trust in terms of, you know, a lot of the processes and the actual journey that a lot of the those decisions have taken. And I think it was more wondering, what can we do to, especially with AI and some, you know, of the real frontier technologies, to make it more reliable. So, you know, whereas you've got in front of you sort of the blockchain journey and what you see and what's happened, as opposed
Absolutely.
to.
I think it's more about how we use it. Yeah.
And what can we do to make that process more reliable? And again, to allow for people to trust and to take that leap, to allow for that decision-making process to belong and to be responsible, well, to be led by AI. How can we make, you know, as technologists and as investors and as people who are interested in pioneering these innovations, what can we do to ensure more reliability behind these products? It's an interesting concept. I mean, it doesn't have to be a question answered. It's perhaps more food for thought. If anything.
Yeah, as you rightly said, like it depends how we use it. So this is where the core of the trust comes from. I mean, we can use it to gather information, to extract all the necessary points that we need, but at the end of the day, it's how we use it and what do we do with it, this information, how we proceed, our decisions. So this is why we definitely can trust it, but all the outcome depends on the people at the end of the day.
Absolutely.
Yeah.
Thank you. I can see that we've had a few more questions in our Q&A as well, and some comments. So sort of building upon the concept behind AI, Adan Wasaja would like to ask, how can AI help with businesses in business evaluation of private company startups for investment by private equity? Alpesh, I can see that that's an intriguing question. Is it more that it's we're not there yet, or it's something for us to think about?
I don't necessarily think you need, well, I suppose you could build a bunch of AI models by looking at historic data from companies and their performances. I don't necessarily think you need AI. You could just use statistics. You know, if you want to say, if you say statistics is a branch of AI, then yes. A lot of companies do that. Let's be honest. You know, a lot of investors do actually sophisticated modeling to understand valuations of companies. You know, they look at market segments. All the big VCs, if you name any tier 1 VC, they have a team of people looking at this, look at the markets. So it's already happening, I would say, in terms of valuations. You know, so when you walk in on a company and a sector, most of these guys already know what your company's valued at, given the traction you have, because they'll have done the research. That's why, let's be honest, if you look at any VC that's investing Series B rounds in large, they know that we need to invest X amount of money. So they already know. I mean, they already know this stuff. I would say private equity firms are probably not that sophisticated. I don't know. I'm not a private equity firm guy, but I don't think they're as sophisticated as some of the venture capitalists that if you talk about the tier 1 venture capitalists like Andreessen Horowitz and Greylock and some of the others, Sequoia, these guys have teams working on this. Yeah, those are more sophisticated. Private equity guys will do valuations based on, in quotes, traditional valuation models. I'm sure they have market models they've built. Some of the private equity firms, I'm sure they have market models they've built. So you know, frankly, you're at a disadvantage if you're going as an early stage company to a private equity firm, because they know more about it than you do. The most sophisticated ones know way more about it than your business than you do, and where it fits and what the value of the business could be. Hence, where they offer you a valuation and offer you an amount of money. I mean, it's simple as that, because they know.
Would anybody else like to comment on that?
Yeah, private equity basically has a longer time horizon, and so maybe is not best suited as an application as compared to, say, a hedge fund strategy where, you know, tomorrow's performance counts, and then, you know, this month's performance counts on the back of tomorrow's performance. So that's where, you know, AI can really stand out and differentiate itself.
Okay, well, interesting. We have had I'd say it's a rather bold statement. So I'm curious to have you either agree or disagree, panelists and speakers. And from Vijay Kumar Mishra, we can't say that AI is always right. This is the human who builds AI models. So only reproducible and rigorously tested models can be thought to use. Do we agree or do we disagree? Or is it not that simple?
Yeah, I think I can partly answer the question. So that's true that you know, AI. So basically, if we think about AI as an algorithm, let's say, it's true that it can make, you know, false statements, in a sense that you know, it's not his decision to make a certain statement, right? It's programmed to make to produce certain results when you feed certain data to this algorithm. So yeah, basically, if AI or machine learning as an algorithm has, you know, has provided you with the results that are somehow that cannot be qualified as a good result, it's definitely not the fault of the algorithm, right? It's the fault of the guy who wrote the code. That's true, but that's another question that we have here. And yeah, you are totally right, Roxy. It's not that easy to you know, to define whether it's true or not. But I would add that when we're talking about AI, we basically, you know, it's super important if we talk not only about the algorithm itself, because algorithm, trust me, you can write whatever algorithm you want to write. It's basically, you have like no limitations, to be honest. The only, like, one of the major limitations that you tend to encounter when you're working with machine learning or artificial intelligence or whatever you call it is basically the data. Even in math, it's always the data. It's always the like, it's always what you feed to your algorithm. And here we have like a big problem, because the way we you know, the way you manage your data, what type of data you tend to use, and how exactly you govern these cases when how you make sure that the data is not poisoned, for example, by one of your competitors, how you make sure that there is that you have, you know, excluded all the noise, how you make sure, you know, that the loss function or any other functions, or, you know, are working properly. So this is the real problem that we have, to be honest. And when we're talking about like you know, being sure that we fed the data and algorithm produced as the results we actually want, depending on the type of algorithm we tend to use. If it's something simple like let's say I don't know, like feed-forward neural network, it might be quite understandable what's going on. But if we move further and dive into the deep learning, the further we go, the harder for us to unpack this black box of AI. And this basically most of the time prohibits you know, our understanding of what's going on, and whether the AI or the guy who wrote the code basically, you know, understands the business problem he or she you know, tries to solve. So this is the real case. And in my opinion, we need to be really cautious, because yeah, I totally agree with Kaushik that yeah, AI or machine learning, definitely it's a hot topic right now, and we definitely see how it captures different markets, different areas of our you know, current work, no matter like what the you know, what the area is basically. But it's true that we need to be cautious when we are applying it, because it's a lot of cases when you can basically apply another model which works perfectly. It has no these problems with data poisoning or these biases or black box problem or anything else, and it works just fine. So this is the real case, and most of the time such models tend to be computationally, they tend to be less greedy in terms of computations and power and time you need to spend on it. So that's true, but it is fact also that for certain cases machine learning can outperform certain algorithms. And the reason we use AI, it's not because, in my opinion, it's not because it's always right, but because there are certain cases where you cannot make sure that you are yourself right. So you just cannot manage to go through all the data you have, or fit into the model that you have right now. So you just have only one option to use machine learning. So this is fortunately or unfortunately the world we are living.
Could there be consideration to perhaps for collaborative technology? So think of it as a hybrid. So we don't solely rely on AI and machine learning for the entire management of that product, I suppose, and that outcome rather. So for example, touching back on blockchain, you mentioned in terms of it's hard to know whether the data has been fed in or it's been cheated by a competitor. But then by bringing in other frontier technologies, you could rule those out. And so you could, in effect, strengthen, by creating that baseline, strengthen the output and the decision making that we are currently not wanting to be too reliant on, by the use of other more reliant technologies that can act as a constructive, I suppose, supplementary product.
Yeah, I definitely could agree with this statement. So basically, compared to some other, approaches, let's call them purely mathematical approaches, it's not the best definition, but the best one I can come up with right now. AI compared to those approaches are rather a interdisciplinary area. So you basically need to apply not only mathematics or not only computer science, in order to come up with the model which basically, gives you the right result. And it tends to be the truth that you need to apply, as was mentioned before by our panelists, that basically you cannot apply just one of the time, just one algorithm solely, right? You need to apply a bunch of algorithms, and in order to get the result that basically makes sense, right? So that's totally true. And I believe that in the future, when AI will be even more developed as it is in comparison to as it is now, we will be able to apply certain collateral technologies, right, to boost the current level. Because even though AI is a hot topic right now and people really love it, and that's true that it's comparatively new technology. It's not comparatively new in terms of math, that's true, but in terms of the technological realization and as and how it works, it's definitely comparatively new. So I'm pretty sure that more to come in terms of AI, and yeah, we definitely will see how it rises with the use of certain collateral solutions as a blockchain, for example.
Yeah, lovely. Would anybody like to expand on that or any further? Yes, Alpesh.
No, I think I did my first AI algorithm thing long time ago. I think I don't think you can generalize around the application of AI. The use case specifics matter. So if you got safety critical use cases where lives depend on it, that's a different set of provability that you have to do on that, right? Mm-hmm. So I've worked on engine oil displays in helicopters where if things, it's got to work, or the plane falls out of the sky and people die, right? If you're talking about, so I don't think you can generalize around the application of AI across everything. You've got to be very specific on use cases and industries and applications. That's for me. So, the generalized thing we do is we were working in data and AI for 15 years. So for us, it's, in the context that we're applying it, as I mentioned, on sustainability. I had a question today from somebody saying, well, can you measure the carbon footprint of a t-shirt accurately? And I said, well, you can estimate it using a model, but it's not, who knows whether it's accurate or not, because there's no reference point. You know, yes, you can benchmark against other data, but that data is also not accurate because it's not measured using real data. Now, interestingly, there's a whole new industry that's emerged recently called synthetic data. I don't know if you heard about synthetic data, where what people are doing is effectively creating data artificially using models to then feed into AI models to train them. So, you know, it's an interesting, so we're seeing that kind of thing emerge, because if you can't train the AI model to recognize something, let's say it's a visual thing, or, you know, like recognizing, I don't know, a card, I don't know, we're making it up, but then you need to training data and you need to label it. How the hell do you get training and labeling data? Well, you have to collect it. Well, if you can't collect it, what do you do? Well, you can create synthetic data. The other thing around, so that's one point. The second point I would say is that AI is just very early in most organizations. If you go, however much the hype says AI is everywhere, the reality is, it goes to most companies, they have point solutions around one little use case that they've implemented. These use cases may be big for a particular organization, but actually only a very few companies out there are leveraging AI to scale. Primarily, the problem is bringing data together. If you can't bring your data together, it doesn't matter what you can do. So the digitally native companies like the Netflixes and the Facebooks and those kind of the big native ones that you'll know about, they built their business from the ground up to make sure they have all the data and then overlaying that AI stuff. So operationally, there isn't that idea around having that data. What I think is going to happen, and it's going to take years, and most companies, is that AI layer, the data layer and AI layer across a business, and then, you know, these point solutions integrating to that layer. Because at the moment, all these companies are coming out with different AI. Say, I've got a model for computer vision, I've got a model for, I don't know, financial calculations, and there's hundreds of these little companies building a point solution for one thing, but the data set they need to use is the same. Well, they say, well, give us your data and we'll run the AI on it. So, well, I don't want to give you my data because my data is all over the place in my organization, and I need you to overlay your model into my data, not the other way around. So that's the biggest operational challenge that I see, is that AI to scale needs things turning the other way around, not these little companies building models and saying, hey, I can do this with this particular model, but actually bringing those layers of the stack together into an enterprise and then overlaying, operationalizing how AI is going to work in a business. And the digital native companies already do it. That's why they're so far ahead. Most companies are nowhere near doing that. So there you go. There are a couple of points I thought I would make.
But there's plenty of room for improvement, just not right now. It's down the line, I think, essentially. I think with what we're all agreeing on is it's there, but it's just not quite right. Okay, so let's move on to, I think let's move off from AI and going back to the questions. So let's, we've had a few comments and questions from Manish Biani. And let's talk about ESG. Do you consider ESG score as one of the technical metrics? And do you mention technical metrics? So as an example, do you take patent valuations into consideration? Does that question resonate with anybody that would want to take that?
So I was just trying to understand the question around patents. I'm just trying to where's the question?
Manish, if you're still online, feel free to just sort of clarify what you mean. But
yeah,
but until then, if we just want to have a discussion looking at ESG scores as one of the main metrics.
Well, I can tell you ESG scores are all BS right now. There is no realism in any of these scores. They're all made up. The data and the foundation of the scoring is completely proprietary, or they use screen scraping. They scrape sustainability reports and come up with a magic score, right? That's what's happening. And it's all greenwashing. There really isn't that. I mean, I don't know if you saw the press release recently where ExxonMobil was in the top 4 of ESG high level score and Tesla didn't even make it to the top 100. I mean, that's ridiculous, right? I mean, okay, maybe Tesla's supply chain is not efficient, but actually an oil and gas company by their nature may do net zero, but the reality is this just doesn't make sense, right? So ESG scores, I don't believe any of them. I wouldn't trust them. However, it's all relative. So if you're in the financial markets and you're taking ESG scores from Sustainalytics or another vendor, it's all relative. So, you know, they grade the scores based upon their own internal model, but they grade people based upon something which is relative to something else. So Nestle relative to, I don't know, pick another company, to Unilever. So
relative.
Investors can make investment decisions to a certain extent because it's a relative score. You could say, well, actually, you know what? It's a relative score. Yeah, Unilever's here, Nestle's here, you know, pick another FMCG companies here. Therefore, you know, you can sort of make investment decisions based on that. So I wouldn't say it's all crap, but
it's just being inappropriately used in a blanket way.
But it's just not used. These, you know, if you're making investment decisions which allow you, which are our money, you know, it's our pensions money and our investment money, and these investors are making these decisions based upon those things, then it should matter, and it's going to matter because for asset managers, investors, and, you know, private equity firms, SFDR is another regulation that's coming in. These guys have to prove this stuff. They're saying what the portfolio composition is. They have to prove what these portfolio makeup is and how the ESG scores fit in. So they can't just get away with saying, oh yeah, we use this ESG index and so it's fine, right? And actually there are 600 different ESG indexing companies out there, right? So which one do you use?
Well, I think someone just commented that that's actually a very interesting point. Kaushik, what do you think? I could see that you had a thought there.
Yeah, so I know based on our chief quant that we do use an ESG score, but I couldn't tell you exactly how it's used in the long short context. But I know it's one of the factors that go into the model. Okay. So not much to add there.
Would anybody else like to add on the ESG front? No. So I think Manish explained what he meant by his question in terms of the patent, which is a number of patents or a content value potential evaluation. Does that add some context? Or shall we move on to another question?
Say one more time.
So his question was, for example, do you take patent valuations into consideration? And he expanded that the patent meaning the number of patents or content, the value potential, is the evaluation.
So it depends on the patent, right? So if it's a patent related to reducing emissions or being making the supply chain more efficient, to reduce emissions or creating a bio product based upon that, you know, I think Manish is in the pharmaceutical industry, you know, building a patents around those areas. Yes, there's value in that around ESG, absolutely, because you're creating value and technology which directly will reduce emissions. So that impact all, you know, social and governance. I don't know what you can do with social and governance around patents, but, you know, for example, drug composition and using different ingredients to make a drug, and you created a patent around that, which adds a sustainability element. Yeah, absolutely. You know, I can see that of being value and the ESG calculation on that could have an impact on valuation. Absolutely.
Okay, I think he commented further on Dow Jones and sustain analytics and the rigorous green technology, but I think what you've said, it kind of covers that quite nicely for sure.
Yeah. I mean, I think there's lots of invention around clean tech, as it's called. There's huge amount of invention around bio products, on food products, I mean, there's so much innovation going on. I don't know how, and a big chunk of these companies are patenting those things. Like, what's it called? Impossible, the meat company, Impossible? Improbable, or whatever it's called.
Yeah, I think, well, not Beyond. I think I know which.
Beyond Meat, those guys. They patented stuff around going whatever, right? So, you know, that's valuable. I don't know how it...
Funnily enough, we will be touching upon that we have a conference next week on sustainability and food tech, which is on I think the 6th or the 7th of June, but I will double check. So for those that are specifically interested in that area, we will share a link for how you can get involved, and we can expand upon that conversation, because I know it's quite a controversial topic with many myths that are in need of being dispelling and conversation to be had. I believe it's Tuesday today. Okay, I know that we need to wrap up quite soon. So I just want to ask one more question, which is an earlier question right at the start, which is going back into the SPAC model. So there are a few comments about this. So one, do we believe that the SPAC model is not favorable for tech companies? And why do we consider that targets that went public via SPACs are unsatisfied, considering that SPACs are performing better than traditional IPOs? Who would like to take a stab at that?
I think, yeah, I can just make a quick note on the SPACs and this type of question. So it always, when we try to compare two things, it's important to decide, you know, what is your benchmark, right? So if we would compare SPACs to the traditional IPOs, I'm pretty sure there are different cases, to be honest. And for certain companies, SPACs definitely might be a great opportunity to raise money and, you know, to went public and all the stuff. But from the whole, I mean, personally, I'm not that like the whole idea of early stage companies going public, because in many cases, if it's a pharma company, at least right now, we have this problem where company they tend to not to get that much attention to their technology, right? So the great idea and the pure realization of this idea, and this basically leads to those cases where companies, they raise millions and tens of millions of dollars and they just went public, where SPAC, for example, because it's easier and convenient for companies, and then they just fail. You know, even pretty much it's often that even before the clinical trials, right? Even before the phase 1, and this basically is not it's not great, not only for investors, but only for this company in particular, right? Because they have compromised their technology and probably their team for some time, at least, right? So I'm not sure that SPAC as an approach, it's really something bad for the company, at least, but it's definitely something that might, you know, spoil the CEOs of different companies and basically led them to the wrong conclusions about their technology, sustainability, their progress as a company, the investment readiness level of their technology, which might lead to the results they definitely don't want to face in the future, where, you know, in the case of the fail, it would be much harder for them to raise capital, and if they would let's say wait for a year or two, they might adjust their technology, making it more sellable, you know, finding better I don't know, scientific advisors and so on and so forth, and after that making this leapfrog, you know, and launching their technology. So yeah, this is the way I feel in this case.
Absolutely. Anastasia, Nikita, would you like to add on that, or are you happy with Alexander's response? Is there anything that you would want to expand on?
I could say that these days, these are quite challenging for the companies raising funds, especially going public. It doesn't matter either they go for SPAC or an IPO. Their retail investors, they could be afraid of putting their money like these days because of the markets going down, like S&P 500 going down. So in this case, going for a SPAC these days could be rather challenging. So in this case, sometimes this could not be a successful strategy as it was like a few years ago. So in this case, I would advise just to go for the traditional way of the private equity strategy. So in this case, it would be more interesting for such companies just to wait and then go public, then go for an IPO. But still, a SPAC could be an interesting idea if you already have built the community of the investors interested in it. So you need also to build your community on the secondary market before you go for a SPAC.
Lovely. Okay, wonderful. So I think if there are any final comments from our speakers today, please do have a moment to make them now.